So our presenter this evening is our Bishop and the Pastor, Dr. Damian Ffriend, who needs no introduction to this audience. He has spent approximately 2 decades in the financial industry and more than that, teaching in the field at both the secondary and the tertiary levels. He has also provided personal financial management counseling to many in his capacity as a clinical psychologist and an eminently qualified financial advisor. We are therefore honored to have him share with us this evening. So at this time, it is my pleasure to hand over to our Bishop.
Thank you. Good evening, everyone. It is indeed my pleasure to be with you this evening, and I am happy to see all who are here at this time, and I trust that it will be a very useful experience for you. Personal financial management, and you'll note that it is part 1. We will speak about part 2 later, as in we will talk about when we'll be having part 2. But why is it important? Why do we need to be having a session on personal financial management? Well, first of all, when we look in scriptures, the Bible tells us that a fool and his money will soon be parted, which suggests that how much we are able to keep and benefit from money is dependent on our mindset and dependent on our level of wisdom. Now, whilst it is that the scripture says that the love of money is the root of all evil, it is not the money which is the root of all evil, but it's the love of it. For the very Bible also tells us that money answers all things. And there is a saying which says that money is an excellent servant, but a very poor master. And therefore, if we want to be able to benefit from money, then we need to learn how to master it so that it becomes a servant and not the other way around. Now, the reality is that personal financial management is something that really should be taught at least at the secondary level of education, but it's not. And very often, you find persons going through their entire life and never being trained in personal financial management. You can even have a degree in accounting, but not understand personal financial management. And so this evening, we will be dealing with some things that I think all of us will be able to say that we may have made some mistakes or poor decisions or uninformed decisions at some point in our financial life because we did not understand these things. It's important to note that as long as you are alive, you can still make changes. We can still make some adjustments. Some things we may discuss this evening that you are quite aware of, and there are other things that may be new to you. Some things may require a paradigm shift. Some things may require a change in our mindset. But again, if we want our lives to be different, then we must be prepared to make changes. If we continue doing the same things that we always do, we will continue getting the results that we've always gotten. So let us not be disturbed or distressed if we find out that we've been doing some of these things wrong. Let's understand that here is a time, here is the opportunity to start the change. The aim of this webinar this evening is to provide some basic guidelines, some actionable points that we can implement in our lives and see difference over time. So we speak about financial literacy, and financial literacy is the ability to understand and effectively use various financial skills, which include personal financial management, budgeting, and investing. Now, you can be extremely literate, but not financially literate. And this is why we sometimes find that persons will come into large sums of money, whether it is that they win the super lotto or they get an inheritance, but they come into large sums of money. Large sums of money that we would think, well, they're set for life. And within a year or two, they're in a worse financial position than they were before they got the money. And that's because they lacked financial literacy. So financial literacy is the foundation of your relationship with money. And it's important to note that this is a lifelong journey of learning. And so those who are on this webinar at this time, we will have persons at different levels of understanding about money. But whatever our levels are, there will always be more things that we need to learn. And therefore, it is a lifelong journey of learning. So let's continue the journey. When we speak of personal financial management, one of the things we usually often refer to is your financial planning pyramid. Your financial planning pyramid. Now, when you look on the screen, you will see this pyramid, and you will note that it is divided into three areas: protection, wealth accumulation, and wealth distribution.
Bishop?
Now, so you can see the different areas there. So we start with protection, then there's wealth accumulation, then there is wealth distribution. Now, interestingly, most persons, when they think of financial planning, when they think of trying to make sure that their financial house is in order, the first place they start is wealth accumulation. So we start looking on savings and deposits, and you want to invest, etc., etc. But that's like starting to build a building at the second floor. You're going to be in trouble. It's important to have the protection layer before you begin to do the rest of it to seek to have wealth accumulation. The protection layer is your foundation. The protection layer is your foundation. Now, I know it's a webinar, but pardon me if I seek to have a little interaction. Who can tell me quickly why it is you think that it is important to have the protection layer before you begin the wealth accumulation phase? Go ahead, open your mic and share.
All right, let me give it a try, sir. Good evening, and good evening all.
Good evening.
If it is that you start to try to accumulate wealth without considering first the protection of life and good health and all of those, you might very well die before that accumulation, that wealth is accumulated.
Okay.
That's the line of thinking and the support I got from my beloved.
All right. Good attempt. Good point. Thank you. Like that. Could I have probably one more person trying? If it is, you have anything to add to that?
Sandrina is saying this helps to mitigate unforeseen circumstances.
Excellent. Excellent. So we've had two very brilliant answers. The
Sir, I
protection phase.
just get the addition.
You just get the addition.
Yes, sir.
All right.
If you don't seek to get the protection first, and you go about seeking to accumulate the wealth, and you, God forbid, you happen to die in the process, whatever debts that you might have incurred during that wealth accumulation phase might very well be passed on to those that are left behind to bear that to deal with.
Good. That's also an interesting part of it. So,
okay, sir.
So you focus mainly on death, and that's an important part of it. But what Sandrina said takes care of the other part of it, which very often is the even bigger issue, where we speak of adverse events. So if an adverse event happens, the challenge you face is that if there is no protection, then your accumulation to that point can be wiped out. You can be set back several years. In other words, you are accumulating, you're seeking to accumulate wealth, and one negative diagnosis from the doctor could be enough to wipe you out or to cause you to have to start over. Yes, one accident, one fire, yes, could significantly impact your accumulation phase. And actually, there are many persons who have had this sort of issue. I'm sure many times you have heard, for example, on the news of a dwelling place or a business place that gets burnt to the ground. And you hear that the loss is 10 million, 20 million, 30 million, 50 million. And then you hear the most dreaded statement: it was not insured. Now, imagine what happens to that person whose $50 million business place, which would include stocks, etc., burnt to the ground. And there was no insurance. So all of that cost will have to be borne by this person. They may never be able to get back home. Yes? Currently, it has been, the statistics show that 1 in every 3 persons in Jamaica ends up with a critical illness before age 60. And gone are the days when critical illness was for old people. The young are getting critical illnesses now. We have teenagers who are being diagnosed with critical illnesses. Now, the average critical illness costs approximately $3 million to take care of yourself and get back on your feet. Now, if it is that you get diagnosed with a critical illness, then that could significantly set you back and significantly impact your wealth accumulation phase. If you had no protection, if you had no critical illness insurance, and you have to pay for it out of pocket. If you were to end up with a kidney failure, for example, kidney failure, if you have end-stage renal failure, then you only have 2 options other than dying. You've got to get a kidney transplant, or you've got to do dialysis for the rest of your life. And you're required in that case to do dialysis 3 times per week. And the cost for each session of dialysis is between $12,000 and $18,000. So we're speaking of 36,000 using the lower figure, $36,000 per week. If you multiply that by 52 weeks in the year, you're talking about a cost of $1.872 million for 1 year, and this has to continue for life. What happens if you have to pay for that yourself? What happens if the motor vehicle that you're driving is not insured and you end up in an accident, and it includes personal injury for others, and their bills come to $3 million, $5 million, $7 million? What will happen to your wealth accumulation phase if you had no protection? So we speak about the different types of insurance that provides protection. But then there's also the issue of your will, because your will helps to protect your investment, protect your wealth, and ensure that your wealth is distributed as you would want it to be distributed. Because if you do not have a will, then the government, the law of the land, provides a will for you. It determines who gets what according to the order of precedence that's in the law of intestacy. And so Administrator General will determine what happens with your wealth. And there are many times you see these nice houses in nice areas that are rotting down, and that's because there was not a will, and they're waiting on Administrator General. So a will can significantly protect your wealth, especially when you get to the stage for wealth distribution. And so it's important to seek to have a will. And if you have a will, if things have changed significantly, then do a new will. Remember, the simple thing to do to adjust your will is simply do a new will. The latest will, the most recent will be the effective will. And then, of course, there's the issue of debt reduction. And we're going to speak more about that in this presentation. So I'll not address that at this point. So as we're talking about working on our personal financial management, the first thing we want to do is to stop and check. Are we adequately protected? If we're not adequately protected, then we need to work on that. We need to put that in place. The few dollars that it will require for you to pay to have this protection will be worth it if and when an adverse event happens, because then you will not have to lose what you've been accumulating, but your wealth will be protected from the effects of these adverse events. Right. So personal finance or personal financial management is the process of planning and managing your personal financial activities, such as income generation, spending, saving, investing, and protection, which we spoke of just now. So let's talk about spend or save. Now, first of all, I'm going to ask you just to use the raise hand feature, and Sanya will tell me what's happening there. Just raise your hand if it is that you believe that you are paid enough. You're working and you believe that you're paid enough, or you're paid well. Just tell me how many hands we've got, Sanya, please.
So far, none, sir.
Okay. All right. So let me see the hands of those of you who believe that you're not paid well enough. How many hands do we have?
So far, 7.
Okay.
9.
9?
We're back to 8.
Okay. All right. Thank you. So several persons believe that they're not paid enough, and no one believes that they're paid enough or paid well. Now, I ask that question because usually the complaint you hear is that we're not paid enough. We need to be paid more. And I will not disagree with you. You know what it is you're doing, and you know your worth. And very likely, you are worth more. At the end of the day, really, most organizations, most businesses are going to be paying what it is they can pay to get the value they want. They would seek to pay the least they can pay to attract the value they want. And so it is not unlikely that you are worth more based on what you're given. However, when we complain about not being paid enough, it is not usually from the perspective of saying, I am worth more and what I am doing is worth more. It is usually from the perspective of what I'm being paid is not enough to take care of the things that I want to take care of and to live the quality life that I want to live. It is important to note, however, that in many cases, the complaint in that perspective or from that perspective happens because we are not utilizing the skills of personal financial management in the best way possible. In other words, the quality of your financial life is really not determined by how much you earn, but by how you manage what you earn. And so if you stop and you think about it, there are many of us, I'm sure, who can look at what we are earning now and remember days when we thought if we were to ever earn what we are earning now, we would be so fine. Yet we are now earning it and we are still concerned because it's not enough. Actually, for some of us, we may not have even desired as much as we are earning now. We couldn't imagine earning what we're earning now and not be fine. On the other hand, you can find persons who are earning less than you are, but they are more financially stable. And you wonder, well, how is it so? It is possible to earn $1 million per month and still live hand to mouth. As strange as that might sound to you, I've known of it to happen. Now, if you're earning $1 million per month, but your expenses are $999,000 per month, then you are living hand to mouth. Even though you're earning $1 million, by the second week of the month, you're in the same position like the persons who are earning $100,000, because by the second week of the month, you are just limping along and waiting and hoping for payday to come. Why is that an important point? It's important because whilst it is, there's always place and space for more money. More money is not the answer in and of itself. We've got to first learn how to manage the funds we have, and then we'll be better able to go to the different levels of income. And at each level, if we are at ground zero now, or we get to 100, at each level, we will still be comfortable and have a good quality financial life. So the question is, do we spend or save? Now, the process of managing your personal finances can be summarized in a budget or financial plan. Let's talk then about a budget, first of all. May I see a show of hands for those of you who consistently prepare a budget I'd say monthly, since most persons are paid monthly. If you're a business person, might be different, but then most times we'd work with monthly. So you consistently prepare a budget monthly, and you seek to follow that budget monthly. Just raise your hands for me, please. How many hands do we have?
8 hands so far.
Awesome. Awesome. So we've got several persons who've been working with a budget consistently. How many of you only do a budget once in a while for yourself? Show by a raising of hands, please. Nobody does it once in a while?
We have 4 hands.
4 hands once in a while. All right. Let me see a show of hands for those who, now you don't do the budget thing. I mean, you don't do budgets. Not for yourself, that is.
No hands so far.
Oh, wow. So we've got a group that is doing very well in this area. Actually, very often when I do a presentation like this, it's the other way around, where most persons do not do a budget. So it means that we're getting it in this area, and that's good. Why is that important? Because the budget is a plan. And if you're operating without a plan, the likelihood of succeeding is very slim, very, very slim. You've heard the little saying, you know, sort of becomes a cliche, but you've heard the saying, if you fail to plan, you plan to fail. The reality is, if you're working without a plan, then it's a hit and miss type situation. And so it's important to have a plan. A budget is a plan. It simply shows how much money you expect to be coming in and how you intend to spend those funds, or better yet, allocate those funds. Yes? So how do you intend to allocate the funds? Now, when you're doing your budget, it's important to note all that you expect to come in. So all your sources of income, all right? You use all your sources of income, put them together so you know the total income you expect to have, and then we work on the allocation of this income. But the first step really ought to be setting your goals. Because if you do not have goals, your budget will not be as effective as it could be. So you might ensure that you do not spend more than you've received. Excellent. But your budget ought to do more than that for you. Your budget ought to be a plan that ensures or helps you to ensure that your financial goals are met. So before you even start doing your budget, you really ought to set your goals. You have your immediate goals that will focus on how you're going to use your money now. What are your current expenses, etc. But then you also need to have your long-term goals. You have your medium-term and your long-term goals. And these deal with saving, investing, and spending over years and decades. Because your financial life will always be a part of your life as long as you live, even after you've retired. And so it's important to have your goals, because when you have your goals, that will help to determine how you allocate your money in your budget, and therefore what is done with the money you receive. We have some goals that we call secondary goals. These are goals that are discretionary. So these are things that are non-essentials, but they are nice to have. And nothing is wrong with that. It is okay. You can put in your nice to have goals and seek to meet them. Actually, the more explicit and specific you are regarding even these secondary goals, the more likely you are to be able to meet them, because you will plan for them properly and you will budget for them so that over time you will be able to achieve them. I know we are in the microwave age where everybody expects everything to be done in a split second. But the reality of real life is that that's not how it is. And there are some things we have to plan for and work towards. We have to have what we call delayed gratification. And so you make some sacrifices now and you make some adjustments now so that you can have a greater benefit down the road. But to do that, you must set your goals, and only you can set your goals. No one can set your goals for you, because goals set by others will not have the motivation, will not provide the motivation necessary to make the sacrifices, to exercise the level of discipline that is required to meet and achieve those goals. The second step is that you must calculate your income and expenses. And so you will pay attention to all your income sources. If you are a family and you're budgeting as a family, then you look on the income from all the persons who contribute to the income for the family. Yes? If you're an individual, you're doing an individual budget, you look at your income. If it is salary, for example, what's your salary after taxes? All right? Your salary net of taxes. That's what you put there, not your take home, because it's important that we recognize the difference, because your take home will be the amount that you get in hand or in your account after you've paid your taxes and deductions. But remember, your deductions are up to you. They're within your control. You make the decisions that lead to your deduction. And so therefore, in your budget should be those deductions. And so we budget not the take-home pay, but the pay net of taxes. Net of taxes, because we have no control over the taxes. So the money that we have left after the taxes are taken out, that's ours to budget. And so that is the amount you budget. Of course, if you have any investment or business income, you also include that. When you're doing your budget, you should include all your income from all your sources. That way, you ensure that all of your money becomes a part of the plan that you're creating to meet the goals that you determine. Now, the next part of the equation is your expenses, and your expenses fall into three categories. The first one is your fixed committed expenses. Fixed committed expenses, so you've made commitments for these expenses, but it's a fixed amount each time. So it might be a specific monthly amount or quarterly amount or annual amount. For example, your mortgage or your rent, it's fixed. You know exactly how much it is, and it is committed. You have got yourself into an agreement, a contract, and so there's a commitment to these expenses, but it's a fixed amount. And ideally, when you're doing your budget, you should break up your expenses in this way, because it helps when you need to be making adjustments. So you have your fixed committed, and then you have your variable committed. Variable committed, again, you have made a commitment. Usually it's a contractual arrangement, except in this case, the amount is not a set amount. It will vary from time to time. For example, your utility bills. Yes, it's a committed expense, but it varies from time to time. And then, of course, you have your discretionary expenses. These are the expenses that there is no contractual arrangement or commitment, And so they are the ones that we consider optional, and you can change those most easily. And so usually when there is an issue with the budget, when the budget is done and you're finding a deficit, which means that your expenses are greater than your income, usually the first place that we look to make some adjustments would be the discretionary expenses, because those are the easiest to adjust because there are no contractual arrangements for those. Now, step 3 is that you need to analyze your spending, balance your account. Now, one of the things we've found is that very often persons do not analyze their spending. And so money has a way of just leaking out, and it's like having an underground leak in your house. You're just realizing that the water bill is coming very high, but you don't see where you're losing or using the water. And so we have some little things that we spend on, and sometimes we don't stop and check them. And so for some persons, it might be phone credit. And we just spend, but it adds up, but we don't realize it. For some, it might be buying food. And when I say buying food, I'm talking about eating out. And so you buy lunch every day, or whether it be fast food or otherwise. But that has a way of adding up. And very often, if we were to make an adjustment to that and decide to cook, for example, and take lunch, we would find that not only are we eating healthier, but we are saving significant amounts of money. Some of us, we are impulse shoppers. So you see something, oh, that looks so good. Or, oh, that's on sale. You don't really have a need for it, and it was not in your budget, but it's on sale. I can't let it pass. And we swipe the card and we spend the money. If it is that your expenses are too close to your income, then you need to stop and analyze your expenses. And one good way of doing that for persons who may have that challenge, you're realizing that, boy, every month, your expenses just out of whack. And you think you should have some money, but it's not happening. One thing we recommend is to get a little notebook and walk with it. And every time you spend some money, however small or large at the amount, write it down and write what it was for. At the end of that month, when you look on that spending history, you will be able to recognize where the leakages are. And when you found the leakages, then you can determine what changes you could make in your operations, in your lifestyle, that would reduce that leakage and give you more money to work with. Because remember, the goal is to ensure that your expenses do not exceed your income. Actually, it is even more than that, because not only shouldn't your expenses exceed your income, you should have money for saving and investment. But we will talk some more about that in a bit. So when you find yourself with a deficit on your budget, which happens at times to probably all of us, you do up your budget and you realize that there's a deficit. If you don't do a budget, then you realize that there's a deficit when you've run out of money and you still have expenses to take care of. But because we're now going to be doing a budget all the time, you would see it beforehand. And what do you do when your budget is in a deficit state? there are 3 ways that you can adjust that. The first and easiest one, usually, is to reduce your discretionary expenses. And having done that, if you still need to reduce more, then you look at some of the other expenses that you could probably come out of certain contracts, etc., and reduce those payments. And that's in cases where those can be changed. Another way to erase the deficit is to increase your income. So you may look at your expenses and your expenses are razor thin, or they're made up of several or mostly contractual arrangements that you can't get out of easily. Then the other option is to look at increasing your income. What can you do to earn some more money? What skills do you have that you could put to use? What opportunities are around? How can you increase your income so that your income will become more than your expenses? And the third way is to do both. Both reduce your expenses and increase your income, thereby giving you a greater fiscal space. Step 4 is that you revisit your budget. You have to monitor it. So you don't make a budget and decide, okay, this is my budget, and you make that January and you carry it through and you use the same thing for your entire year. No. Monitor it. Yes? Check it back and see. Are there things that need to be adjusted? Do I need to massage this a little bit? Do I need to change this? It's important to revisit the budget. It's important to assess what changes may need to be made. It's important that you pay attention to the fact that you sometimes have additional funds coming in. And so your budget never included that money that your cousin or your auntie or your whoever sent you from foreign, that, you know what I mean, you weren't told you were going to get. But now you've gotten it. Your budget for the month ought to be adjusted, because if you do not make account for it, it is very likely that it will just fritter away, and then you wonder what happened. Now, of course, sometimes your estimates may have been off. And so again, making the adjustments allow you to be able to balance your inflow and outflow. An important part of creating your budget is that savings should be a part of the plan. I just want to remind everyone that ideally, you should seek to have an emergency fund that is made up of at least 6 months of income or 6 months of total expenses. In other words, it should be able to take care of you if you have an emergency, or if you should lose a job, etc. Now, to have 6 months of expenses in an account or 6 months of income in an account, it's not going to happen overnight. But it means then in your budget, you put in a line item for an amount that you'll be putting aside to your emergency fund each month until you get your emergency fund to the place you need it to be at. Remember, for your emergency fund, you should not have ATM card walking around for it, because if you do, you're likely to dip into it. All right? Your emergency fund should be something you can get to readily in an emergency, even if the emergency is on the weekend. But it should not be in such a way that it is easy for you to just readily access on a whim. So even if you have an ATM card for it, just in case you need you need it on a weekend because the emergency is on a weekend. That card should not be in your purse or your wallet. That card should be put away somewhere that you're not even seeing it. But at least if you have an emergency, you know where to find it. Now, even as you do your savings, one of the things that might work is to have different savings accounts for different things. It's one of the things that persons who sell in the markets, for example, are very good at. They have a little bottle or an envelope for everything. And so when they sell, they put the partner money in this envelope, and they put the insurance money in that, and they put some money in this for back to school. And we wonder sometimes, how is it that these persons are able to accomplish a lot of what they do? But it's because they follow some basic principles that very often we don't. And so it makes sense to sometimes have separate accounts so that you can save separately there. Now, for those who are very disciplined, you can use one account and you keep in records, and then you can manage your things from that. You know you're saving for your insurance, you're saving for your vacation, you're saving for your car insurance or your house insurance, you're saving for your vacation, you're saving for school fee. At the end of the day, if it is that you're using one account, you must be monitoring it very carefully. You've got to be very disciplined to do that. We suggest that you use a 50-30-20 rule. 50% of your income goes to fixed costs, 30% to your variable costs, and 20% to your saving funds. Of course, that's a recommendation. There is nothing set in stone. You determine. Yes, you can have 50% going to savings and investments. Why not? But finally, regarding the budget, it's important that you're committed to the budget. In other words, don't just have it on paper. Follow it. Follow it so that when certain things come up, you decide, I'm going to check my budget. Because if that's not in my budget for this month, sorry, won't be dealing with it. Unless, of course, it's an emergency. Or it is an opportunity so great that you really cannot afford to miss it. In which case you need to decide, well, what else? What are you going to shift? What are you going to change? What are you going to give up? But you must remain committed to your budget. Otherwise, doing a budget will not serve you any lasting benefit. It will not provide you any lasting benefit. Remain realistic and evaluate your budget. Adjust it as often as you need to, because budgeting is about allowance. Just a recommendation for your seasonal expenses, don't wait until the time comes and then you have to try to find all of the money at one time. That tends to put us under pressure. So you know that you're paying school fee every term. Then let's save the amount across the 3 months so that when the time comes, you have it. It's easier to find it. You're paying your car insurance once a year. Work it out. So your car insurance is, and of course I'm going to use a number that's easy to work out. So your car insurance is $120,000 for the year. So that's $10,000 a month. Put $10,000 per month in your budget for car insurance, and you put that money aside. When it's time to renew your insurance, you don't have to be running around and wondering, okay, we are going to get someone, okay, I might have to buy some, okay, I might have to do some premium financing. No. Break it down and save for it each month. And so at the end of the day, it will be way easier for you to be able to afford that expense. I just want to remind you that your budget is a living document. Your life is constantly changing, and so your budget will need to constantly change. So regularly review your budget and adjust for changes in income and expenses. If your income drops, you may choose to eat out less. If it goes up, don't eat out more, but save more. Pay off some debts quicker. And of course, you can make a discretionary purchase here or there, but you should first of all think of saving more, not spending more. One of the biggest challenges we have is that once our income goes up, immediately our expenses go up to meet the income. And that's why, irrespective of how much we're earning, we're still living hand to mouth. What is recommended is that when your income increases, you maintain your expenses at the current level for a minimum of 6 months. What that does, it allows you a buffer. So that additional money, because you were living before anyhow, yes, it was hard, but you were living. So when your income increases, that difference, put that difference toward your emergency fund. If your emergency fund is already at the level it needs to be, put that additional income towards savings. And we're going to talk in a while about what you do with savings. Put it towards savings and continue living at the level that you were living before, meaning your expenses level, at least for 6 months. What that will do is that it will ensure that you will not return to a hand-to-mouth living situation. We also recommend that you do some automatic saving. In that case, what you do is speak to your financial institution and set up the deduction. You will find that one of the easiest ways to save is to have the money going directly to your account from your pay. If you don't get it, you won't think about spending it. And after a while, you will forget that that's the amount you actually earn, because you're going to be budgeting what is now left. You're going to, because it's not available. And again, for that automatic saving, for that one, do not have an ATM card at all. Do not do online banking. Yes, let that saving be such that if you want to touch it, it's going to be some inconvenience. And so you're less likely to go and trouble it because there's just, a little whim here or there. All right. Now, for some of you, you may have loans, and the loans include automatic saving. When the loan expires, don't just take that money and go spend it. Either add it to your other savings that you're having, or what you do is that you can allow the automatic saving to continue so that you continue saving there. Again, as I said, we're going to talk about what to do with savings in a little while. All right? Stay with your budget. Remain committed to your budget. If you stick to it, you will see results over time. So do not give up on it because it's a little difficult now. You're not used to having to hold yourself like this. Don't worry. If you stay with it, it's going to work for you. Over time, you'll get used to it, and then you'll find that you'll be better able to handle all the expenses that you have, whether they are regular or seasonal. Now, when you're talking about your personal financial management, you must pay attention to your income, because at the end of the day, if you have no income, then you have nothing to plan for. But we must pay attention also to spending, and we started talking about that earlier. Now, spending includes all types of expenses. All types of expenses that are incurred to buy goods, or services. All types of expenses for or spending for consumables. It does not include investment, however. Investment is not considered spending. It is a cash outflow, but it is not considered spending. Spending speaks of expenses. Investment is not considered an expense. Now, all spending fall in two categories: cash or credit. And I know you know that cash, it will be the spending that comes from the money you have, and credit, spending that comes from money you borrow, whether it be a loan or a hire purchase, or some persons differentiate loan from borrowers. I find that interesting, So they say loan is from an institution, and borrowers is from, your friend and family. Of course, that's not an official distinction, but yes. So credit spending, borrowed money. Cash spending, your own money. Now, managing your expense is a major part of ensuring that you can accumulate wealth. And so having good spending habits is critical to good personal financial management. Now, we spoke quite a bit about savings, and you already recognize that saving is critical for your personal finance. However, I want to go to another point, and I want to say to you that too much saving is actually a bad thing. Too much savings is actually a bad thing. And I'd like to invite somebody to tell me why you think too much savings is a bad thing.
Ricardo just raised a hand, followed by Marvin.
Okay, so let's hear from, who you said was the first one?
Ricardo.
Okay, so let's hear from Ricardo, then let's hear from Marvin. Go ahead, Ricardo.
Evening, everyone. Sir, I believe that in the case of saving, say for example, you're putting money in a saving account. Usually the interest is not that much, if any at all. So there's not much growth except for what you are putting down. So say a $10 you put down for the month, it's just that dead $10 for the month. So it's not really growing as much as you would want. I would think that that's one of the ways.
Okay, thank you, Ricardo. Excellent. Let's hear from Marvin, and then we will go forward. Yes, Marvin.
Yeah, to reinforce Ricardo's point, it's idle money, as in the banks have that money to use to their leisure, which is not necessarily to your advantage. Because one of the things I notice these days is the fact that if you have money going into a savings account, every time you put money in there, the date for the calculation of the interest is reset to the date that you put that money in there. Now, if that money remains idle for a particular period of time, the new measures in place is that the bank charge you a fee for dormant fees. And so, really and truly, you are there sending all this money into a savings account with the hope of getting an interest, when really and truly, at the end of the year, when you realize what you gained, it would have been minimal to nothing. And that money could have been better utilized had you placed it in an investment account, wherein you would have to appreciate your own level of risk tolerance. And
excellent. Don't give me the full dissertation, but excellent. So both of you answered excellently. Absolutely on the mark. Absolutely on the mark. Having too much savings is a bad thing for your personal financial management because savings earn little to no return compared to investments. And then what's worse is that very often there are also some costs. And so when we look on the interest rates for savings in Jamaica at this time, interest rate on savings account range from 0.1% at the low end to 3% at the high end. And that 3% at the high end is not found many places. Actually, you'll most likely find that in some credit unions. Now, what that means is that if you put down $100,000, for example, for an entire 12 months, and let us say you're not at 0.1%, but you're at even 1%. At the end of the 12 months, your interest on that $100,000 would be $1,000. And remember, there are usually taxes and charges that are very often applied to the accounts depending on the rules governing that account. Now, if you decide to do a fixed deposit, the rates available for fixed deposit is somewhere from 1.25% up to a high of about 6%. And to get that 6%, you usually have to have a few millions. And so you have lump sum you put aside, you lock it for a particular period of time, and your interest rate is between 1.25% to 6%. That's a high of 6%. Most persons are going to be finding themselves somewhere in the middle there, probably about 3%. Whilst at the same time, inflation, your inflation rate currently in Jamaica is 5.something%. At March 2021, the point-to-point for the year was 5.2%. The most recent one it was 5-point-something also. So we're talking about, remember now, with inflation, that speaks to the loss in value of your money. So $100,000 at the beginning of that year would be worth 5.2% less at the end of the year. Now, if you look on it, if you put the money down for a year and earn 1% interest, and inflation is 5.2%, then what would have happened is that you would have lost 4.2% in the value of that money you saved. Now, it means then that when you put money in savings accounts like that, you really lose money over time. The question you might then ask is, well, why have you been stressing that we ought to save? I've been stressing that you save because we save for two reasons. One, we save to take care of expenses that we know are coming in the future. And two, we save to be able to accumulate sufficient funds to make worthwhile investments. So savings are important, and it is a foundational part of your wealth accumulation phase. But savings must not be a goal in itself. Savings must be done with the aim of basically accumulating funds to be able to invest, which is where you will now start really earning money. In other words, that is how you get your money to work for you. And you had the trustee board, thanks to the trustee board, you had a great webinar, I think it may have been 2 webinars ago, on investments. And when we do part 2 of this, we will touch some more on investments and give some more guidelines, etc., on investments. But investments is where you need to be going, because until your money start working for you, you will never stand a chance of getting to real wealth phase. As long as all you're doing is exchanging hours for dollars, there's a cap on how much you can accumulate, because there are only so many hours, and persons will be only willing to pay you up to so much per hour. But when your money is working for you, when you're sleeping, you can be earning. When you're on vacation, you can be earning. When you're retired, you can be earning. And so this is where we talk about making the money your slave rather than your master. And so we save to be able to take care of expenses that we know are coming, and we save to be able to afford good, worthwhile investments. A next point that is important, which is all linked to this, is that every person should pay themselves first every month. And what do we mean by that? It means that you should determine what percentage of your pay you're taking out for yourself, which is going to be going to your savings towards investment, because that's how you ensure that all of the money you're working doesn't go to everyone else. And at the end of your days, your work days, for example, you realize you earned so much, but you have so little to show. It is how you ensure that as life progresses, you can get freer as it concerns financial constraints. You're better able to afford certain things as life progresses because you've been ensuring that you pay yourself. Now, too many of us, every month we work for everybody else except ourselves. We work to pay Flow and Digicel and JPS and Water Commission and the banks and everybody else, the children, everybody else except ourselves. And that's not good. Because if you're saying your boss doesn't pay you enough, yet you're paying yourself nothing, aren't you worse than your boss? And don't tell me that you treat yourself to some food. Are we gone back to the level where we work for food? No, you need to be paying yourself. And so you should determine an amount that comes out of your income every month that goes towards saving, not saving towards expense. Remember, we save for two reasons, but savings toward investment. That's how you pay yourself. In the financial industry, it is usually said that you should pay yourself at least 10% of your income each month. Now, all we're saying in that case is that 10% is minimum wage. You can pay yourself any amount, but ideally, you should look at 10% as minimum wage. Now, some of you may not have been doing this, and so you're going to have to make some adjustments. And making the adjustments now, you might not be able to afford 10% for yourself at this point. That's fine. But start with something. Start at 5, for example. And you might say to me, but how am I going to do that? Well, you may have to make some adjustments to your budget, as we spoke earlier. Cut some things. Make some adjustments. Yes, but at the end of the day, it's important that you start paying yourself. That needs to be a goal of yours. Now, some of you may be so heavily leveraged that until you get something off, you can't do that because there's nothing else you can shift. It's fine, but have it as a part of the plan. If you have it as a part of the plan, then you will find that the first opportunity comes, you will start paying yourself. What it might mean is that in the meantime, you'd pay yourself ad hoc. So you get a little money that you never expected. Rather than say, thank you, Jesus, and go find something else to spend it for, pay. Say, thank you, Jesus, and pay yourself. For the Christians, after you pay your tithes. Yes. And not just for the Christians, by the way, because what you will find is that all wealthy persons, you will see that whether they're Christians or not, they follow the basic principle of giving, and because they understand that by giving, they receive. And so some of them may not pay it over to a church, but they do it to charities, etc. So at the end of the day, if you're not a Christian, if you don't believe in the Christian principles that way, just remember that the principle of giving and receiving, sowing and reaping has nothing to limit it only to Christians. It is a law of nature that God has put in place, and it works whether you are saved or not saved, whether you're a practicing Christian or not. The next thing you want to do is to pay your bills promptly. Pay your bills promptly for two main reasons. One, to ensure that you avoid late fees and charges. Late fees and charges take away money from you that you're getting no benefit for. So you're spending money and receiving no benefit. Late fees and charges are taking away money that you could be paying yourself. So it's important to avoid late fees and charges by paying your bills promptly. Also, there are some companies that will give you a rebate. And so you get refunds, rebates, you get points, etc., that can be redeemed because you've paid your bills promptly. The second reason is that we must remember that we now have credit bureaus. When you pay your bills late, it affects your credit rating. When it affects your credit rating, it means that money will cost you more to borrow because you will have to pay higher interest rates because you're considered a higher risk. What that does is that it again takes money from you that you could be using to pay yourself and increase your financial stability and your wealth accumulation. Then we must look on how to get out of debt. Now, one of the first things you want to do is to stop and just note all the debts you have. What are the debts you have? What's the interest rate you're paying on these debts? When will these debts end? What's your monthly payment? And when you look on these, look for the debts that have very high interest rates. Remember, the Bible says that the debtor is slave to the lender. High interest rates will hang you. High interest rates will stress you out. And so, if when you do your listing, you realize you have several debts with high interest rates. One of the things you can look on is what we call a debt consolidation loan. What that is, you find an institution that has a much lower interest rate, and you seek to get a loan from them to pay off the high interest rate loans. When you do that, that will release quite a bit of funds for you that you can now start using to do some of these things we were speaking of that you were saying I'm unable to do because of how things are. So if it is that you have several loans with 30% interest rate, for example, and you're able to get a loan for 15% interest rate to pay off those 30% interest rate loans, immediately you're looking on a reduction in your debt payment or your debt servicing bill of approximately 50%. Now, it's important that we look on doing these sort of things to begin to free ourselves up so that we are not consistently spending money with everyone else without benefiting us. When you think of credit cards, for example, the average interest rate for credit cards is between 48 and 55% per annum. At the end of the day, these are the type of debts that if you are able to access a lower interest rate loan, it makes sense to use it and clear those. Some of you may have loans from some of these microfinancing organizations or from some of these persons or organizations that are called loan sharks, where you're talking about interest rates of 15% per month, 20% per month, 25% per month, not per year. When you have a loan with a 20% per month interest rate, you're talking about 240% for the year. Now, those loans are usually easier to get and to get in a crunch, but those loans ensure that you work and work and work and see nothing for it. And so we need to seek to get out of those debts. Very important. Now, if your debt is excessive, then as we said, try to see if you can renegotiate repayment terms, try to see if you can consolidate your loans. If you need to find a professional debt counseling program, do that. But it's important that you get yourself to a place where you are in a much better position. Very often when we're in a bad financial position, it affects everything else. Many times when I tell persons as a counselor that the number one cause for marital and long-term relationship breakup worldwide is not infidelity, they look at me shocked. But yes, the number one cause is not infidelity, but rather financial problems. Financial problems have a way of causing us to do silly things, causing us to not be able to sleep, to be stressed. Let us start trying to make the adjustments so that we can truly manage our personal finance and enjoy the fruits of our labor. So having said that, we need to talk very quickly about the difference between bad debt and good debt. And so I'd like to again invite someone to tell me what they think is the difference between bad debt and good debt. What is a bad debt versus what is a good debt? You know.
Yes, I was saying that I believe that a good debt would be debt that you incur because you want to make a sound financial investment. For example, a mortgage, because that now or a piece of land that would be able to build wealth or build capital, and also it will be there for generations, and it can be passed on as estate to your families. A bad debt now would be something like taking out a loan to go to carnival.
Excellent, excellent.
Sir, well, when I say bad debt and good debt, I look at it within the context of serviceability. That is to say, whether or not the payments that are due to be made are honored in a timely manner. If that's the case, then the debt is said to be a good debt. The debt is said to be bad if the serviceable state is not good and there's no hope of getting back that money. So in essence, because it seems futile, you have no choice but to write it off as a bad debt.
All right, thanks. Now, that answer would have been accurate for accounting. So in accounting, that's exactly the difference between a bad debt and a good debt. For personal financial management, it means something different. So in accounting, if the debt cannot be recovered, if the debt it's become delinquent, we call it a bad debt. And so we write it off. A good debt is one that is being serviced well. For personal financial management, the term bad debt and good debt carries a different meaning. And so the meaning that Leo shared is the meaning that it carries for personal financial management. So a good debt for us in our personal finances is a debt that has the potential to increase our net worth or to enhance our life in an important way. So when we talk about a good debt, we're talking about a debt that is expected to earn for us or to increase our net worth. And remember, your net worth is the difference between the value of what you own and the amount of money you owe. All right. And so that is why sometimes we see some persons driving some nice vehicles, for example, and wearing some nice things, and we think, but sometimes their net worth isn't much because the things they own are high value items, but what they owe on it is almost the value of it. And so their net worth is very little. If the value of your assets is $10 million and your outstanding debt is $9.5 million, your net worth is $500,000. Now, someone can have assets of $2 million and debts of $100,000. That person, though their assets value less, would have a higher net worth than you because they have net worth of 1.9 million while you have a net worth of 500,000. Now, a good debt for your personal finances is money that is borrowed that will increase your net worth. Very important. Bad debt, on the other hand, speaks of borrowing money to purchase rapidly depreciating assets or borrowing money just for the purpose of consumption. All right? That is considered a bad debt when you're looking on managing your personal finances. So when we talk about talking about borrowing money to make money. And if you remember, it says it takes money to make money. So if the debt you take on is going to help you to generate income or build your net worth, we call it a good debt for personal financial management. Some examples are education. And even with education, we have been advised that you should not borrow more for your studies than you would expect to earn gross in your first year on the job. Now, of course, earning it gross in your first year on the job, you can't pay it off because you've got your expenses, your taxes, etc. But it is said that you shouldn't borrow more for the studies than you expect to earn in the first year. And it's considered a basic rule of thumb. The idea really simply is you shouldn't borrow so much to study that you're working 40 years and can't pay off the loan. It means that you would have borrowed too much. It wouldn't have been worth it. Not from a financial investment point of view. All right? Now, some other good debts are for your own business, borrowing money to set up your own business, if it is a well thought out, well planned business. All right. Remember, let us face the facts. Let's face the facts that the stats say somewhere in the region of 9 out of every 10 new businesses fail. Does it mean that we don't go into business? No. But just want to say, remember, you've got to do your research. You've got to plan carefully before you go into business because you want to be in the 10% of success. All right? Borrowing to purchase your home or to purchase other real estate, good debt. Borrowing to pay off higher interest debt, good debt. Borrowing to invest in good investment, good debt. Yes? Bad debt, as we said, if you're borrowing to purchase rapidly depreciating assets, that's considered a bad debt. If you're borrowing, it's not going to increase your net worth, it's not going to generate any income for you, then it's considered a bad debt. Yes? So, for example, borrowing to buy cars is most times a bad debt. No, it can be a good debt in some ways. If it is that this car is going to be earning for you, then it's a good debt. If it is that you require the car to do your job, so it is therefore helping you to earn, it is a good debt if you do not borrow to purchase at a level that is more than you can comfortably afford. If you are, for example, a traveling officer, whether private sector or government, and so you receive upkeep, but you receive upkeep only if you have a vehicle. So borrowing to buy the car would be allowing you to earn that income. The rule of thumb for that to ensure it's not a bad debt is to make sure that your loan repayment is not more than the upkeep you receive for the car. If it is that based on your work, to get to and from work, especially based on your times, where you live, etc., you need to have your personal vehicle, then it is a good debt because it is helping you to go and earn. But again, it is only a good debt if it is you ensure that the amount you borrow will not significantly impact your income. It shouldn't be that the amount you borrow, you're borrowing it to go to work, but then you're working to pay that debt. Then really, that's a bad debt. Borrowing to buy clothes and consumables, bad debt. Goes without saying. Borrowing to go party, like Leo said, or borrowing to go on vacation, or borrowing for your wedding, bad debt. All right? And so you look on the debt and you work through, is it going to pay me back more than I put in? Yes? When I factor in the principal repayment and the interest payments, and I look on what are the alternative uses that I had for that money, what we call the opportunity cost, does the debt still make sense? Are you getting all your money back plus some? Could you have done something better with the time and money you're investing? It's important to assess. Now, a credit card debt can be a very bad debt, or it can be a good debt. Now, with credit cards work for you if you know how to work it. So how ought a credit card to be used? You use the credit card during the period, usually a month, but you use it only to the level that you will be able to repay in full before the due date. Once you use it and repay in full before the due date, you pay 0% interest. What does that mean? It means you get an unsecured loan that you pay nothing for. If you do not repay in full, however, then you're going to be hit with that 48 to 55% interest rate. And that can build up and can significantly impact your financial status and your personal financial plan. Now, what's worse is that most persons do not know that for almost all the credit cards available in Jamaica, how they work is that if you use the money in the period, so you use the money in the period and you pay back some of it, not all of it. When the interest is being calculated, it is calculated on all of what you used in the period, not what is left. So in other words, you spend $200,000 on your credit card in the month, and you pay $180,000. And so you only have 20,000 outstanding. The interest is not calculated on the 20 outstanding, but on the full 200,000 that you use. Therefore, the only way out of that is to pay everything. Paying minimum balances, the bank loves you, and your personal finances will consistently suffer. I must quickly say that JN Bank was the only bank that had put out a credit card that would allow the interest to be charged only on the outstanding amount and not the full amount used in the month. I know that there was another bank that was saying they were going to do the same, and I do not have evidence that they have started that yet. So in general, your cards are going to be charging you on the full amount you spent in the month unless you paid off everything. Another thing you need to be careful of with your credit cards, ideally do not pin your credit card. Why? If you pin your credit card, you're going to be tempted to do cash advances. Cash advances are extremely expensive from your credit card. And in those cases, your interest is charged per day. Therefore, you should never do a cash advance from your credit card. Having said that, how can your credit card then be a good debt? It can be a good debt if you ensure that you pay off all the amount you owe within the period. So you use 200,000, you pay off 200,000 before the due date, and then you use again. So you pay no interest. But it is a card that gives good rewards or cashback. It means that you're paying no money, no interest, but you're getting rewards. You're getting cashback. Then that's a good debt. You are earning from that debt rather than paying out for that debt. And so that can be a very good debt. I must quickly say, I spoke about the fact that JN Bank has a card that doesn't charge you on all that was used, but only on the outstanding. But I must also tell you that they don't have great rewards or cashback currently available from that card. Just making sure that I am very transparent. Now, when you're getting your loans, there are some things you need to pay attention to, because all interest rates are not calculated equally. So when you go to borrow, there's an interest rate that's called the nominal rate, and that's the stated rate. So for example, they say to you that the loan interest rate is 10%. That's the nominal rate. Now, two places can tell you 10%, but it doesn't mean that your payback would be the same whichever of the places you take your loan from. There are several things to consider. The first one is your interest rate simple or compounded? Simple interest is going to be charged on that principal amount only, whilst compounded will be charged on the principal amount plus any outstanding interest. So if there's outstanding interest, it's added to the principal amount, and then the interest is calculated on that. So automatically you're paying more. Now, how often it is compounded is also very important, because the more often it is compounded, then the greater the amount that you will pay. So the effective rate is higher. So a 5% compounded quarterly would equate to 5.095%. If it is compounded monthly, it's 5.116. If it's compounded daily, it's 5.127. And understand that though it might look small, this point, that it adds up and it is significant. It can be significant, especially depending on how much you're borrowing. Another thing you need to look out for is whether or not your loan interest is calculated on the straight line or reducing balance. Straight line method, it means that the interest is calculated on the principal amount that you borrowed, and that's what is calculated on to the end of the loan. Reducing balance method, however, the interest is calculated on the reduced balance of your principal. So as you pay down your principal, your interest payment is also reduced, because interest is calculated on the amount of the principal that is left. So with straight line, $100,000 you borrowed, okay, $1 million you borrowed, it is going to be calculated, that 10% is calculated on the $1 million every year until the loan ends. If it's reducing balance, let us say at the end of the first year, you've paid down $100,000 of your principal. Then in the second year, the interest would be calculated not on $1 million, but on $900,000. So if it is, your loan is on the reducing balance method, then you actually pay less interest. Most credit unions tend to use reducing balance method for their loans. But as I said, ask about these things, because it makes a difference. It's important that we learn to shop around for our loans, because we are managing our personal finance. All right, so we shop around, we ask questions. Is the interest rate fixed or is it variable? Fixed interest rate means that the interest rate will remain the same for the life of the loan. Variable or adjustable interest rate means that the interest rate can go up or down. Unfortunately, most times it never goes down, but it goes up. And you could then find that you have a loan that was comfortable initially because it was calculated at 8%. But then the interest rate goes up and you find yourself paying 14% on that same loan. And that now puts you in a predicament. It's important to know if your interest rate is fixed or if it is variable. And if it is variable, you need to ask about the terms. I will not go into all the technical details, but you ask them. So for example, a 3% 5/1 adjustable rate mortgage with 2.16 cap. What does that mean? It means that the initial annual interest rate of 3% will remain fixed for 5 years, after which it may be adjusted once each financial year. That's what that one means. The first adjustment cannot be more than 2%. Subsequent adjustments cannot be more than 1%. And the lifetime maximum interest rate is 6%. So it means that this loan that started out at 3% could go up to 6%, which is a 100% increase in the interest rate. And by the way, many mortgages are adjustable rate. We need to ask about these things. We need to check on them, whatever type of loans you're taking, because it will make a major difference. All right. Now, just a quick glance, as we're coming close to the end of our time, a quick glance at some of the average interest rates that are available. in Jamaica. So credit card between 48 and 55% per annum. Unsecured loans, 15 to 30%. Secured loans, 8.5 to 10%. And these are averages, yes? Secured loans with property, 7.5% to 12% per annum. Motor vehicle loans, 6.25% to 7.5%. Mortgages, 7.5%. Microfinancing institutions, 10% to 15%, not per annum, but per month. Now, let us remember this too as you work through your financial plans. Let us remember that interest rates are not set in stone. If it is that you're considered a good risk, means that your credit rating is good. I mean, you have, they can see clear income that should allow you to be able to comfortably service the loan. Your credit rating is good, which says that you have a record of paying your debts and bills on time, etc. You very often can negotiate the interest rates. Now, many persons do not know that, and so many persons, even though they may be in the position that they could negotiate, they do not even try to negotiate because they think it is set in stone. No, it is not. Now, if you're not in a position that you can negotiate because your financial status, your credit ratings, etc., might not be excellent at this time, that's fine. What we're doing now is working on building and fixing so that in the end, we will get there. So I want to quickly look at the top 10 questions to ask when you're seeking a loan, and some of you may want to jot down some of these. 1, what is the duration of the loan? How long is the loan term? Important. What is the interest rate on the loan? Very many times we are seeking to get a loan and we don't even try to find out about the interest rate. We really just want to know what's the payment going to be per month. But we should check. We should check on the interest rate, because ideally you should shop around for your loans because you are looking out for your personal finance. Find out if the loan rate, interest rate is fixed or it is adjustable. And if it is adjustable, you need to know what are the terms for the adjustable rate. Yes, what is the maximum that it could be adjusted to? All right, because remember, all interest rates are not calculated equal. You may find that there is a company that's charging a higher interest rate, but it would be better than taking this one that's a little bit lower, because this one is adjustable and based on the caps, it could be double or triple, while the other one is fixed. So you ask these questions. How is the interest calculated? Is it straight line or reducing balance? Is it simple or compounded? If it is compounded, how often is it compounded? A good question to ask, even if you're not good at all of these maths things and working these, a good question to ask is, how much interest will I pay in total? Now, the financial institutions are required by law to tell you this, but usually they don't tell you verbally, and they don't usually point it out to you. They make sure it is in the forms that you're going to get, that you're supposed to sign. And of course, with all of those readings and writings, you're not reading all of that. You're just glad that you're qualified for this loan and you sign for it. And then you carry home those papers and you put them down and you don't look at them again. Ask them, how much interest will I be paying in total over the life of this loan? Also, what are the associated fees and what do they cover? Because for some lending institutions, the associated fees, what they call processing fees or some name to that effect, many times all it is a way for the financial institution to make some money on the front end. Whilst some will ensure that it covers insurance. so that if you die whilst the loan is still outstanding, the insurance will pay off the loan and your loved ones will not have to worry about losing the asset or being asked to pay it, or your guarantor is being asked to pay. Some may have critical illness insurance, which means that if you become critically ill, then the insurance will pay off the loan or the debt, and you don't have to focus on that. You focus on getting better. Or it could have unemployment waivers, where it is that if you become unemployed, then the insurance company will pay the monthly payment for a specified number of months. And that allows you to be able to try to get yourself employed again without you having your loan or your debt going into the bad debt that Marvin spoke about, which is that the accounting term now, where your debt gets classified and you're in trouble. Yes? So if two companies are charging the same amount of processing fees, but one is just processing fees, just admin, and the other includes life insurance or loss of employment insurance or critical illness insurance, then it would make sense to go with the one that is giving you something for some of that money. Plus, also note that in most cases, processing fees are negotiable. And so that's something you should also discuss, because you might be able to get something off it. Question number 8, how often is payment due and by what date? Important. And why is the by what date important? Because sometimes you will go into these arrangements and your thing becomes due on the 12th of the month, but you're not getting paid until the 25th. It means that every month you end up being late. Your payment is late. And depending on the arrangements, that could be costing you money, or it could be affecting your record. So find out when it is due. And very often you're able to negotiate when to put the due date. Sometimes you cannot negotiate where you put the due date, because they'll tell you that whatever time it was disbursed, that's when it becomes. In that case, one of the things to do is to pay 1 month in advance. That way, you're always early. Find out if there's a penalty for early payoff. You should not be borrowing loans that are going to leave you in a position where, having put your things in order and you're able to pay off early to seek to reduce the interest that you pay, you are going to have to pay a penalty for paying off early. Now, if there is a penalty, you need to know what the penalty is to see, is it worth it? There are some lenders that will calculate what is the interest you must pay on the loan for the duration. And they will have a clause which requires you to pay the entire amount, even if you pay off 1 month after you got the loan. You must pay the entire interest that you expected to pay over the 3 years or the 4 years. Now, those loans, for example, there's no point in trying to make them a part of a loan consolidation, because you do not save anything. And so we need to know these things. So we ask them. And finally, what are the penalties for late payments? Very important. You don't intend to pay late, but you still need to know, because that way you know what you're working with as you take care of your financial plans. So then, for the time we had this evening, we spent some time looking on some of the basic fundamental things that need to be done to ensure that we can truly start planning and managing our finances in a better way. And I thank you for sharing and being a part. And though I think I have ended dead on time, I will with permission, allow for some questions if there are any other questions left. So we started with the hard part. This is the part where we stop and we look on what we've been doing and we figure out, okay, how do we make some of the changes to start putting ourselves in the position to truly make use of the accumulation phase. Now, the next session, which is part 2, we're going to be looking on the accumulation phase in depth, looking on how you can maximize the accumulation phase so that over time you can significantly build your wealth. And then I believe that the plan is that the next after that will deal with your wealth distribution and your retirement phase. So we're taking it through step by step to ensure that we are in the best financial position possible. Again, I want to say to everyone, you may not be where you want to be right now. Having gone through these things, you may realize that you have made some wrong decisions, some ill-informed decisions, some mistakes, etc. That's okay. It's a part of life. But if we can start changing the paradigm, changing the way we think about things, and making some of these adjustments that we spoke of, then we will be on the path to getting our financial status where we want it to be over time. It will not happen overnight, but with good plans, with starts, with the goals, as we spoke of, then we should be able to get there. Thank you so very much.
With comment, so the 10 questions are very good. I never really considered the associated fees and what they include. And that's coming from Sister Sandra.
Thank you, sis. Glad that that could help.
Oh, she made another post. I'm thinking though that the only option is to seek another institution.
Sometimes that's the option, and let us recognize, and it's one of the things I was trying to get out. I'm not sure if I got it out there clearly enough, but let us recognize that these days, it's not like in the days when of the high interest rate regimes. These days, the financial institutions are seriously seeking to get loans, as in to disburse loans, right? They all have targets for the loans that they want to disburse. They are pushing and they are competing for the loans. Now, it means that as the consumer, you are in an advantageous position, especially if you're considered a good risk. And so you do have the power to shop around, and which is why I pointed out a lot of these things regarding the loans, right? And so we look on the interest rates and how they're calculated and the questions to ask. Shop around, and that is why your goals are so important, because ideally you don't want to have to be seeking the loan in a mad hurry and dash. You want to have your things planned so you have enough time to literally shop around and choose the one that best fits your goals based on your personal financial management.
Sir, for me, I am happy that you touched, especially because I didn't know about the penalty for early payment. And, you know, sometimes in planning, you know, you say you can borrow some money because you're expecting a bonus or you're expecting a lump sum at a particular point, which you will be able to use to cover that loan. And then now to hear that you need to find out whether or not there will be a penalty for early payment.
Indeed.
So I never would have thought about that.
Excellent. There are many of them that have penalties, and they will not usually tell you up front. It will be somewhere in the midst of all of that, right in that mumbo jumbo. For some of us, you know, it's a mumbo jumbo in the midst of all of that. But if you ask, you'll get the information. So it's important to ask because some have exorbitant penalties for early payment. Like I said, the penalty is that you still have to pay the same amount of interest you would have paid if you kept the loan for the full duration.
Bishop, I've experienced that before because I usually take a loan from this person, and when you pay off early, you get like as an example, suppose you borrow like a $20,000. Just giving you an example, and you pay off it, they give 1 month to pay it off, and you pay it off like in 2 weeks, you'll get like $3,000 off. I didn't know. So when I heard it recently and I said to her, I never know that there is a lower thing when you pay early. She said yes, and she pointed out that you never asked.
Yeah.
So I was like, wow. So it's really, I've heard it before. It's really good to really ask, you know, because they are not telling you.
Exactly. They're trying to get they're building their business. You have to pay attention now and recognize that your financial welfare is your business. So just the same way they're building their business, you take care of your business.
Okay, sir, we are really happy that you've made yourself available to do this session for us. And you've provided us with quite a bit of information that some of us may have to go and do some homework or identify where we're at this moment. And then, as you said, it's not too late for the next session. Then we'll be able, or better able, to see what next to do. So we thank you for being here. And I'm sure that the information that you've provided, that we will make use of it.
Thank you all. It was a pleasure having you. Thank you for your comments that are coming in. I'm glad that you found it informative. God bless you all, love you all, and make use of it. Let's do this together. Like, share, comment, and subscribe. Don't forget to hit that notification bell. And for more, join us at 9 a.m. on Sunday mornings at 10 Union Square, Crossroads. If you can't be there in person, join us virtually via Facebook Live.